Welcome to Brian's CFE Preparation for Chartered Professional Accountants. Today, we are going to cover investments under ASPE 3051. Businesses buy shares of other businesses to gain access of another market, gain a competitive advantage, or increase profitability. This section of ASPE is about ways to record investments and its significant influence. Investment of significant influence means holding more than 20% of voting interest in the investee. Holding more than 20% of voting interest means that you can alter a company's dividend policy. It's basically contributing major decision-making within the company. However, holding less than 20% voting interest doesn't confirm significant influence. To recognize significant influence, we can now decide whether to use cost method or equity method. Cost method is investment that is recorded at purchase cost. Any dividends resulting from would be recorded as dividend revenue. Equity method is the same way as investment is recorded at purchase cost. However, current value of investment is adjusted based on profits and losses. For example, Netflix Inc. net worth is $190 billion. Your company purchased $57 billion worth of shares of Netflix. Because $57 billion is 30% of $190 billion, the investor is considered a significant influence. For treatment of significant influence, there are two methods, the cost method and the equity method. With the cost method, your company would record $57 billion in long-term investment asset account. In the first year, Netflix Inc. has made $1 billion in revenue. 30% of $1 billion is $300 million. $300 million is to be recorded in the financial statement as revenue earned. However, with the cost method, revenue amount earned isn't a long-term investment, but an account receivable. Now, with the equity method, the $300 million revenue earned will not result in accounts receivable. Rather, it'll increase long-term investment in Netflix by $300 million. As a result, the long-term investment in Netflix is now $57.3 billion because of adding $300 million to the original cost of $57 billion. We must impair investment periodically, as well as if a major change occurs to the investment. Assess impairment at the end of each reporting period. Some indicators of impairment is bankruptcy, significant change in the market, and etc. When there is a significant change, we must impair investment to the higher of the present value of cash flow expected or the amount to recognize for selling the asset. Let's now consider an example of impairment of investment. Blue and Yellow Inc. acquired interest of ABC Inc. for $8 million on January 1st, 2023. The net worth ABC Inc. is $20 million. The investment pays dividends to Blue and Yellow of $300,000 in the year. On August 31st, 2023, ABC had a massive market fluctuation and the fair market value of the ABC decreased to $14 million. Blue and Yellow could have earned dividends for the next 10 years. The current market rate is 4%. Blue and yellow uses equity method. We first have to determine recognition of investment by finding out whether the investment in ABC is significant influence. Because blue and yellow hold 40% of ABC, it has significant influence. Therefore, it has decided to use the equity method. As a measurement of initial investment, the amount is to be recorded as investment in ABC in the balance sheet for the acquired cost of $8 million. For subsequent measurement, blue and yellow received a dividend of $300,000 in the year. With the equity method, the amount of dividend received will reduce investment in ABC for $300,000. The investment in ABC therefore be $7.7 million. This is to take $8 million, subtract $300,000. For subsequent measurement for impairment loss because of market fluctuation, we take the higher of fair value of ABC or present value of discounted cash flow. The value of ABC decreased to $14 million. The present value of discounted cash flow for the next 10 years with the market rate of 4% is calculated at $811,000. So we take the higher amount, which is $14 million. The impaired amount of $14 million times the investor share of 40% is $5.6 million. The value of ABC was $7.7 million. So $7.7 million subtract $5.6 million is $2.1 million. Blue and yellow should record impairment amount of $2.1 million in the balance sheet. In summary, investments under ASPE talks about significant influence and the way to record investments such as cost method or equity method. Both cost method and equity method are recorded at cost. For subsequent measurement, we assess any indicators of impairment and perform impairment accordingly. Here, we went over ASPE 3051 investment and whether an investment is a significant influence. I hope this video was helpful and feel free to message me if you have any question. Have a great day.